Hey everybody, Preston Bryn here with our Trader User Group Weekly Roundup. This is for the trading week ending Jan 25, 2019. Well, before I jump into the chart that you see here on the screen, it's the daily of the E-mini S&P 500 futures. We've had a pretty good strong start to 2019. The S&P and the Dow are both up over about 5%. It's roughly the S&P's best start since about 1987. The Dow is up as I said, a little bit over 5% too. It's its best start since 97. And NASDAQ is up over 7%. So we've had and that doesn't count the lows that we're off of from late December. Uh, the past week, we saw a pickup in technology. It finished up for the week. It was the best performer of all the S&P sectors at 76 basis points, slightly under 1%, while the worst performer was healthcare. It was down about 1.21%. The current PE ratio is just a little over 17 for trailing, and for forward guidance, it's about 15.74. So fairly valued in my mind, given the reduction in growth forecast for 2019. But we're still down about 18 to 20% from the valuations we had about a year ago today. So that's a good thing. And this last week in January, it's going to be a really busy week. I mean, on the trade front, we got the Chinese delegation led by their number one guy. He reports right up to President Xi, Premier Liu. He's coming in. He's going to meet with our head of negotiation, Mr. Personality himself, Robert Lighthizer, he's very good, but he's very tough. So they're going to be meeting January 30, 31, trying to avoid this crucial March 1 deadline that Trump has put on China to see some movement. The markets right now are pretty much, although not 100% clearly, but they're pricing in that some kind of deal is going to get done on some of it, not all of it. So they're going to be able to make some progress so that both Xi and Trump can, belly up to the podium and say some good news. So I suspect that is probably what's going to happen. Now, we've also got the FOMC meeting this January 29 and 30. And the Fed Fund futures is not pricing in a rate hike. I think it's like 50 basis points of a chance of a rate increase. The current rate right now is 2.25% to 2.5%. And by the way, there's only like a 5.7% chance of a rate hike in March and a 9.4% chance of a rate hike in May. Going all the way out to June, there's only about a quarter of a percent, 25% chance of a rate hike. So this is a big change from what we saw in December when Powell pretty much intimated that we're going to be, moving forward with more rate hikes and further quantitative tightening, to use the words he used. It was on autopilot, and then the markets really that accelerated the down move we got in December, and I think he got he got schooling really quick in just the words that he uses. So that is now become the central bank, the Fed's put on the market. So that's kind of taken that worry off the market, at least through the summer months. So it turns out the bond market was correct, which it normally is. It was saying you're not going to hike the rates. And that's what the bond market was forecasting. Now, also the end of this week, we get the Labor Department is going to release its January jobs report. Most economists expect pretty good solid job gains and the employment rate at around 3.9 or 3.8%. So still the economy, while the growth is slowing dramatically, it's still growth nonetheless. All right. So we're seeing some revaluations in most equities out there now, which is what's kind of paused the market where we're sitting. On the earnings front, corporate earnings front, they have been coming in lower clearly, but the bar has been lowered so much that things still look good. I mean, this week we get a lot of tech companies, mega cap tech companies like Apple and Facebook, Microsoft, Amazon, all of them coming out this week. We also get Alibaba coming out. And this past week, we saw semiconductor stocks heating up. And that's a good thing because many people view the semiconductor sector as kind of a canary in the coal mine for the rest of the markets and clearly for the tech market. So the Philadelphia Semiconductor Index last week was up 4.4%. So that seems to be all going well as the credit markets, especially the lower end of the investment grade bond market, corporate bond market, which I talk about a lot with our members here. It's so important to follow the triple Bs. There's money out there for corporations to go hit the bond market, and boy, hitting it they are. They're taking in more and more of this stuff. Now, eventually, it's going to come all undone, and we're going to have the mother of all bear markets, but not now. But boy, when it hits, for our members, we're going to do really well because I can just see this building up here. Meanwhile, we're already seeing the U.S. presidential campaigns heating up. The 2020, the Dems are going to be like the Republicans last time. They're going to put like 20 or 30 people in front of the podium. And what I'm seeing from the Dems, they're coming up with, I saw it written down. I thought it was pretty funny. They're coming up with the Willie Sutton tax plan. For those of you that may not know who Willie Sutton is, he was a famous bank robber. And when they finally got him, they asked him why he's robbing all these banks. And he famously said, because that's where the money is. So the Dems want to go after the rich. They're going to play the populist view and really go after them. And, to quote the Rhodes Scholar, Ocasio-Cortez, she calls it the tippy top plan. I mean, if that woman had one brain cell, that would be lonely. But anyway, I look at this market really. We focus on price action because I was looking at the performance results of a lot of big, very established, well-known funds, as well as prognosticators from Barron's to Wall Street Journal and their top picks for the year. And every single one of them underperformed, every single one. So that just goes to show you, I don't care what degree you've got or where you come from, you're just subject to the whims of trying to predict which side of the yellow line the drunk is going to step on next. So we've got to follow price action, and that's where we do really well in our user group. We follow that closely, regardless of what these idiots are saying when they belly up in front of the VAR. So, I view the real global challenge personally. It's not the China trade tiff. It's not global warming or it's warming. It's not policy mistakes by monetary policy mistakes by the central banks or other central banks around the world. I think the real challenge over the next 5 years, 10 years is going to be the idiot rat brains that have been elected to run our countries, from the U.S. to, of course, in China, they don't elect them. But that's a whole nother story. To Europe, central banks, all these other countries, it's going to be a nightmare. Most of these politicians, Republican and Democrat, are kind of tied into pandering to their own respective idiot constituencies. So I just think in the long run, I wish I could do a pair trade where I short the politicians and go long turmoil, or as I like to say, viva volatility. And that's where I think it's going to be. And speaking of volatility, as a reminder, and then we'll jump into the charts. For those of you trading VXX, and we've been trading VXX pretty rapidly this year. I've been short VXX when it was up relatively high back in November, December timeframe. I've been short VXX. It's been a good trade. But VXX is not an ETF, it's an ETN, meaning exchange traded note, and all notes come to an end. So Barclays is going to end VXX on January 30th. But recognizing a good thing when they got it, they're going to keep VXX. They're just going to change the ticker to VXXB. Bravo. So on January 30th, they're going to switch over. Right now, VXXB doesn't have too much volume, but I suspect this week all the volume is going to shift from VXX to VXXB. If you're currently in VXX, whether you're long or short the stock or the ETN, or you've got calls or puts on it, you're going to need to shut it down, or the brokerage firm will cash you out on it. And then you can switch over to VXXB. It's going to trade the exact same way, the same mechanism, the same front and back ratios and futures. The calculation is going to be the same. This time they're going to extend the life of it, I think, out to either 20 or 30 years. VXX, when they created that, they didn't know just how strong it would be. And they did it in February of 2009, and now we're going into February 2019. So it was a 10-year ETN. So that one terminates VXXB. So Viva VXXB. Let's go take a look at the charts here. As you see on the screen here, I've got a daily chart of the E-mini S&P 500 futures. You can see the 2019 high. We're near it. You can see where we kicked it off from the 2018 close, and look at the 2018 low here. I mean, we're down around 23.16. The S&P futures was down 21.39% at the lows when we hit these lows on December 26th. I mean, we actually moved down, and then look at that bullish engulfing pattern here. I mean, it's just a beautiful pattern. And it was kind of a signal that the markets are ready to start moving higher. And we just had a brief dip in 2019, right? We closed 2018 up around the 2505. We had a brief dip down to about 2438. And then after that, on January 4th, when Powell came in and basically reversed course on the FOMC, this has been like a great FOMC move right here. Earnings have not come in as bad as people thought because they had priced in a recession for 2019. And as I told my members, we're not going to have a recession in 2019. Or I can't say we won't, but the odds favor we won't. You can see where the all-time highs were made in September before we crashed at 29.47. I don't think we're going to make it up there, guys. I just think there's enough turmoil in the markets that we're not going to make it. We do have some serious overhead resistance here. You can see this yellow line's the 200 EMA. This straight horizontal yellow line is where all the volume, the most volume took place over the past quarter, is sitting right here. It's called a market map, and it just maps the volume over a 90-day look back or a 90-bar look back period. So you can see where all the volume has occurred. And we're kind of sitting in this wide range right here. Right now, you can see a major volume, from this range right here, and it's not going to be a straight line. And then we'll look up at the peak right up in this area right here, So we're sitting right in this area right here, kind of towards the bottom of this volume area here. And now we're resting. We've had this huge V bottom like that. As I told all my members, these V bottoms are very rare. Doesn't mean that we can't have one. And it looks like we're in the process of this. A V bottom, basically, what all it really means when you hear people talking about it, all it really means is we do not have a pullback of substance. And if we look at this, let me get my pen off here. I keep wanting to let's get my drawing pen off here. So if we look at this V bottom right here, I mean, it's really clearly a nice little move, right? I mean, and a lot of longs missed this move right here, because when we got down here and then we got back up in this area right here, a lot of longs was expecting a retest back down here. So they were loading back up on the shorts. That's what they were doing. And we didn't get that move. It just did not happen. In fact, we came down just a momentary dip. Powell came out, and now, boom, we're up here. So it's given us this V. I think we've got a tremendous amount of overhead resistance up here, okay? And the only thing that's going to allow us to get up here, earnings are pretty much coming in above expectations, but keep in mind those expectations have been reduced dramatically. The only thing I see really moving us up here, it's already factored in, as I told you earlier, going all the way out to June. There's only about a 25% chance of a Fed rate hike. So that means that's priced into the market. It's priced into these, what you see here. So really the only thing that's going to move it now is the China trade deal. If that goes through, we're going to bust a move through here. And then this area right here will be a resistance point for us, okay? And just knowing how Trump likes to play the stock market with his policies, I would not be surprised to see it move up and then this become a longer term support area. I don't think we're going to get a dip back down into this area here in the near term. I think as we start moving through springtime into the summer, we are subject to some downside move. But that's kind of what it's looking like right now in these markets. Now, that can all change. I mean, right now, the Feds are projected to keep their foot off the accelerator as far as interest rate hikes, and they're going to come out with their quantitative tightening policy. And if he can back off his autopilot, and there's already speculation that he is, well, we've got the Fed put in place. I think we're going to have a Trump chi put in place for them not wanting to see the markets go, because remember, China is a lot worse off than the US as far as pullbacks. So that's a little bit about where we're sitting here. Okay. Now, if I step it out to a weekly and just show you again a 90 bar look back period on these market maps, you can see here going, and this goes all the way back to the summer of 2017. You can see we're at a major point right here. That yellow line shows where all the volume, the most volume that has taken place at price going back to the summer of 2017 is right here. Folks, that is a huge overhead resistance area. And it's going to take quite a feat to move the price action up above it. And if you look at it, and I blow up my chart a little bit just so that you can see it a little bit better, you can see here that it projects a pivot high. Well, let me just, that would help if I got rid of my drawings, wouldn't it? But it projects well, why is that doing that? Let me just try it again. Oh, there we go. Okay. So it projects a pivot high all the way up here and a pivot low all the way down here on a weekly chart. Why? Because we've just had such a huge bout of volatility. And you can see that yellow line right there is where the bulk of the volume has taken place going back to the summer of 2017. And that's where we're sitting here. And then the next one down is right here, okay, which is near our pivot low. And then the pivot high is sitting right up in this area here. And then there's another one here. And then a prior pivot low there before we came undone. So there's a tremendous amount of overhead resistance up near our pivot high and a tremendous amount of support down near our pivot lows. And we're almost kind of in the middle. You see that teal line right there is the value area of this pivot range, which wouldn't surprise me because that's where the value area is there going back for a year and a half, goes summer of 2017, which happens to be near our 2019 high for the E-minis. So try and pick a direction, this way or this way. Well, right now it's a 50-50 shot. I can tell you where the markets seem to be lining up. Sentiment has definitely shifted in 2019 to more upside than downside action. But it will not take a lot from Lighthizer or Premier Liu to really push this market lower or higher. So some of the trade action, like for our members, we're going to be looking this week where our action is going to be in what we call the gator trades. And the gator trades are really great for us. We've had a lot of success with them. So for those of you that are members, I think you're going to enjoy them for this coming week. Now, if we come back and we look at, the other markets or the other futures markets, and if we come back into a daily here, and let's take a look at the Russell, which is small and mid cap. Remember, January is the best for small and mid cap. And for those of you members, and I know we had a number of members take the trade, when we were falling here, mid cap or small cap was falling so far behind mid cap. It wasn't even funny. And I was touting doing pair trades where you're long IWM and you're short the S&P. And that turned out to be a great trade. The Russell was down 27.28% from its 2018 highs back. And we hit that low again on December 26th. Okay. And now we've got this V bottom move right here also. And we're coming into some serious overhead resistance. You can see on the daily chart, just like the E-minis, we're trapped between the 50 and the 200. And the 200 is north of the highs for all of the indexes right now. It's going to take a lot of momentum to get us back up there. But this was a great trade. January tends to be the most favorable month for small and mid cap. Okay. December as well, but because December was such a capitulation, we haven't had this worse of a December since 1931, to give you an idea and our frame of reference. So we've had this move here, and I do expect some more consolidation. And then everything is going to tie into Powell's words this Wednesday and Lighthizer and Lee's meeting the end of the week. And I promise you, you're going to be sitting there watching the screen, and all of a sudden price action is just going batshit crazy. Maybe going up, maybe going down, and you're going to wonder what it is. Well, it's going to be one of two things. It's either going to be Powell or Lighthizer coming to the podium and saying we had a productive meeting, we're making progress. Boom, Dow up 200 points from wherever it was, right? Or we haven't made much success, we're having difficulty. Boom, Dow down 300 points, and that's what's going to cause it. Okay. I still believe the central banks and their monetary policy is going to be very accommodative, but that's mostly priced into the market. Where we get the biggest move in the market is when we get surprises. And I can tell you right now, the way things are setting up this week, the surprise would be they don't succeed in the China U.S. trade conversations. That's good for a 400 or 500 point Dow move to the downside. Or Powell comes out and talks a little bit more hawkish than people expect. Those would be the surprises, and that would move us back down, back into the red for 2019. Okay, so those are the concerns that I have on these markets. And like I said, trying to predict it is like trying to predict where the drunk is going to step next. You can't. You can see him leaning left or leaning right, but all it's going to take is a strong gust of wind and the sucker's on his ass on the other side of the road. So this is kind of where we're sitting right now. If we look at NASDAQ, because NASDAQ has had, like the others, a tremendous V move off the bottom. All right. Again, here's the market map. We're sitting right at the major volume area. We're sitting near the 2019 highs off of the lows that were again made December 26th. It's and just like all the other indexes, we started the year, we moved into the red, and then on the 4th, Powell came out with his comments and away we went. So this is as much Powell's move as anything else. So that's why I'm a little bit suspect here in some of these wicked moves that we've got. Okay. We've got to be very careful, folks. I mean, we just have to be very careful. And then, of course, if we look at the Dow, same thing. We've got this move here. Again, the lows made on, you guessed it, December 26th. We had that bullish engulfing pattern, a slight dip. January 4th, Powell comes out and away we go again. So it's not as much earnings are so great we're moving up, but it's, hey, Powell is going to, take his foot off the accelerator, slow down so we can enjoy the scenery more. All right. We actually moved the Dow futures above the 200 EMA, but closed slightly below it. So, and in fact, I need to just update the chart here. We actually moved up and made a new 2019 high intraday on the Dow futures. Okay. So, and then I could also come in here and I could do this on the other charts as well. I'll probably draw it for the next weekly update. But if I were to connect the downsloped trend line there, this is going to serve as overhead resistance as we move up. If we move up here and we start coming back down and go back below the 50 EMA for all of our indexes, all of our futures, we're going to come down and we're going to test the 2018 close, which will put us near the red or in the red for the year if we move below the 2018 closing price. And again, it's not going to take a lot from Lighthizer or Powell or any of these numbers that are coming out here to spook the market. So we've got to be very careful. Again, for our members, we're going to be looking at the gator as, a possibly good way to play this market. So that's a little bit about what we're seeing here. And if we look at China, and you look at the tracking index for China, you can see here, and let me just set it, refresh it from Friday's close. China is also up off the lows, but remember, China was down 38.35% at the lows that China made. And China's lows were made on January 3rd. So it continued to sell off. And now we're in the green for the year for China. But off of the highs, it's still ugly for the Chinese market. Now, EEM, for our members, we're playing some country ETFs to the upside. And you can see here as I adjust this screen for the 2019 high, EEM has moved up nicely um, off the lows here. Now, the lows in the emerging markets were made back in October. All right. And we were down a little over 27%, 28% in the emerging markets. And you can see where we are now. We're at a major resistance point. So we're coming up to some resistance areas here. It's going to take a lot of strength to move these markets through it. Got to watch it very quickly or closely. If we look at volatility, let's look at the VIX. VIX, again, is in the yellow zone, but it's still in the yellow. You can see up in this area here, I was shorting VXX. You know, anytime we get up into the red zone, I encourage our members to take either puts on VXX or shorting VXX, maybe hedging it with long calls. But it's a good, highly successful trade. Okay. VXX is the ultimate long-term short, but you've got this exposure risk of this big gaps here when you have a week or a month of high vol, right? Now we're back down in this area again, but we can stay elevated and vol. Typically when you have volatility spikes like this, you have elevation and it stays elevated for a longer period of time, kind of like a sore cut on the arm. Now I've color coded my VIX screen to give us different, just a very visual reference point of different strategies we want to look at from an option perspective. I didn't need to do it, but you know, it really shows you kind of where the ranges are from green down below, roughly below 15 to a yellow zone to a slightly red to red. And then up here we got a black swan, right? So that's a little bit about what I'm looking at in the VIX. Now, if we look at the front month term structure, you know, this is for folks that are trading the VXX or shortly the VXXB. You can see we're back in the green again. This means that the VIX is lower than the front month volatility futures. Okay. You can set this up on your screen if you want. But what I'm showing here is anything in the green shows a contango environment in the volatility. Anything in the red is a backwardation. I look at the front month term structure and I look at the back month, which is essentially February and March. You can see even in the back month, both of them have moved from backwardation into contango. So this shows a little bit further out in time. This one right here, the back month term structure, is it's the driving engine for VXX or soon to be VXXB. So that's part of our trading plan and volatility. So for our members, we're going to be going into more detail on that in our Option Masters education series. If you're not a member, I highly encourage you to come in because we're doing a lot of really great things with it. But this is volatility. Now, if we look at treasuries, the credit market drives the equity market, not the other way around. You can see here it was attempting to break out of this regression channel to the upside. My chart seems to indicate this Elliott wave 3, 4, 5 pattern, which would suggest interest rates are going to go lower. Or if we move up here, interest rates would go lower. If bonds come down here, interest rates would go higher. So we're still not really breaking out yet. This would suggest interest rates are going to go lower along with the markets. Okay, so I'm watching this very closely. And there are trades to take out of this, but there's no trade right now on the bond market. And then, of course, if we look at the currencies and look at the dollar here. Now, remember, it's a dollar index. It's not just the dollar. And you can see we had this breakdown here. That break here suggests the dollar is going to go lower. Okay. And that means other currencies that make up the dollar, of which the euro is about 58% of the dollar index. We broke this regression channel to the downside. A retest up here sometimes happens, but it suggests a little bit more of a lower move in the US dollar. Now we get that. That means we're going to get a stronger move in some of the other currencies. Look at the British pound. The British pound has been all over the place with the Brexit, and it's moving up because it views the Brexit vote as going to be postponed. All right. We can take all of this gain away if it's not postponed. But we've moved up off the lows here around $1.24 just in the middle of December. That's a huge move in a currency, folks. Currencies tend to trend. The trend here in the pound is to move back up. And you can see these value areas here. I think it's a bit stretched. And Theresa May's got her work cut out for her. And I just believe she's in a no-win situation. So we're going to watch this. Here's some day trades in the pound, but I'm not going to try and predict the direction, although price action seems to show it wants to go up. Probably better is the euro. You can see the euro here. I think we're going to be in a wider chop range here. I don't think the ECB experiment over the next decade or two is going to be able to last. I just don't see how they're going to be able to do it. Too many different country policies from Southern Europe to Northern Europe, Eastern Europe, Western Europe. It's trying to like herd cats. I don't see them making it happen. So Super Mario Draghi is in a boatload of hurt. They're at a negative 40 basis points right now, and last week he did not raise the rates. In fact, he talked about potential further stimulus because the strongest economy over there is Germany, and everything from Germany, from the PMIs, the manufacturing index, and others is showing a slowing of growth, or in fact a contraction. So Draghi is at the bottom range of his interest rates. Hell, he's negative. So what happens if that whole market rolls over? Where does he go from there? That's going to wash up to the U.S. shores. So if there's any contagion effect from China and Europe, we're going to feel it here in the U.S. Even with our slower growth in earnings, yet there's still growth for 2019. It could just backfire and all roll over on us. So that's where some of my concern and risk comes from. So that's a little bit about what I'm seeing there in the currency market. Energy, well, we had our big trade here, and we had members that took the trade. Let me just put it back on the daily here so I get these market maps lined up. You can see up in this area here, I was saying short oil. This is when Goldman and everybody else is saying oil is going to $100 a barrel. I just said there's no friggin' way. We're starting October. The market's starting to roll over. Oil is going to go with it. Okay. It's just not going to go in the opposite direction. I said oil would probably come down to the low 60s. And yeah, we went there, but we overshot and came down. We did a little bit of an overdone down to the bottom. We literally came down to about $42 a barrel. Now we're moving back up. But I think, and I had said off of these lows here, oil is probably going to move to the mid 50s. And sure enough, we moved right up to 54.45. I think it's going to have a hard time holding this level here, and it's going to turn into a barometer for global growth. If global growth continues to slow, the U.S. continues to pump out oil because we're now the biggest producer of oil given our shell. This suggests oil is going to come back down again. Okay, so I'm going to watch this very closely. We made some long moves off the bottom. We were able to profit from some of the short moves down. So now I'm kind of in a sideways chop pattern till I get a little bit of a clearer direction where we are with oil. If we take out some of these pivot lows around the $50 barrel range, then I think we're going to come back into the mid 40s. Okay, so it's kind of moved to my target area and it's resting here right now. So that's a little bit about oil. Gasoline, same thing. Okay. Gas, I was suggesting short in gas, but not in October. I was suggesting short in gas back here in the summer months, right in these areas right up in here. In June, July, and August, I was saying gas is going to roll over. Why? Because the inventory levels were so damn high. We were well above the Bollinger Band range of a 5-year average of gasoline inventories. And I just said, it's just going to roll over. And then when oil gave it up, gasoline gave it up as we're going in, and then boom, it just came down. So for our members that took some of these trades, they made a killing in the energy markets. And now we're bouncing off the bottoms. This again suggests a little bit of a limited upside move, but then a possible rollback over again. So we got it. We're right at a value area, which is acting as resistance. I mean, the downward slope on the 200 and the 50 EMA suggests, if anything, this consolidation is going to roll back over again. So that's gasoline. Nat gas, we made some great money in nat gas, guys. And we've traded it in both directions. So let me just put it back out here again. If you look at this move right here, we had this humongous move up. And then we formed this symmetrical triangle. And typically with a symmetrical triangle, the technical pattern calls for a break in the direction that you entered it, which means a break higher. I didn't see it. I mean, I really didn't. And we took a short right in this value area here, and we rode it all the way down. It was great for us. And then we've had the requisite bounce up, and then we took a short, or I was telling our members, let's sell it again. Off of this area here. Now we're back down here. I think any move higher is going to move it lower anyway. Okay. We're getting ready to come to the end of the seasonally strong period of nat gas. We've had a lot of volatility in nat gas because inventory levels are higher than their 5-year average. Again, for those of you that like to trade the energy markets, whether it's nat gas, gasoline, or oil, you've got to keep track of the 5 and 10-year inventory levels and the seasonalities and the seasonal tendencies of these products. Otherwise, you're going to be operating at a disadvantage. Okay. Day to day, it can go up or it can go down, but week to week, using weekly charts, you've got to really watch these things. So that's what we did with the energy markets, and we did fairly well. We're also looking at a couple of other things in the precious metals market. Look at gold. Remember, I told you this is a very narrow and probably a minor formation of a handle on a cup and handle pattern, right? I've been bullish gold since we were bottoming out down here in August, September, October timeframe, suggesting selling bull put spreads underneath the market because it could have gone lower, right? But then once it started forming this cup and this cup pattern, then I started looking for the handle pattern, right? I mean, once we had this kind of movement like that, I said, all right, well, we're going to start to form this right side of the chart, which is the handle pattern. And where is it going to come into? So we moved up here. We moved down. That's a very narrow dip. And now we're back up here again. I ideally would have liked to have seen the dip back down to the 200 and back up. But that weak dollar that we saw on Friday really bounced the gold prices back up, and we're back into this tight area right here that we sat in the summer of 2018. Okay, and we can sit here for a while. If we get a lift out of that, then I'll be interested in going long because my system is projecting a movement up to around 1360. And if you look over on the left-hand side of the chart, you can see that's pretty much where we would end up. But either way, I've been bullish the gold market, and that to me just still seems to be, the kind of the way you want to play it. Okay. Same thing with silver. We're looking at others as well in that market. We've got some things that I'm looking at in ag, and there's some other things in different countries that we're looking at for trades. We got some trades on in some of the countries in the emerging markets, which seem to be working really well for us. Okay, so this is kind of what I'm looking at right now, guys. Be very careful. If you miss, like a lot of traders, you got out of the market in a capitulation sell in late December into the holidays, and you're looking at jumping back in here, I wouldn't. I would sit and wait for a little bit of a pullback. If you miss a run up, don't jump in because we're near, I think, a consolidation point here for a little bit of a further move back just to consolidate. And that's kind of what the price action is showing right now. All right, everybody, have a great weekend. Members, I'll see you Sunday night. Again, if you're not a member of our group, highly encourage you to come in. We're making money in 2018, and I see 2019 even being more fun. All right, take care, folks. Ciao now.